Hi, this is Manny Vacchiano. I'm going to talk to you today about some key risks that drive the stock price of biopharma companies. This is an AMP QuickE. That's an educational session for biopharma investors that I'm hoping to keep to 10 minutes or less. The factors I'm going to talk about today relate to small and mid-cap biopharma companies. Broadly speaking, these are companies with market caps of around $100 million to $5 billion. These companies are usually losing money, like they're losing lots of money, $10 million a quarter in many cases. That's because their key assets are in clinical trials or they're early commercial. And clinical trials and early commercial efforts, they cost a lot of money. The risks I'm talking about affect the stock price because when the risks go up, the stock price goes down. When the risks go down, the stock price goes up. And there are three risks I'm going to talk about today. And drum roll please, the first risk is regulatory approval risk. This I've broken into two aspects: clinical trial results risk and the risk related to regulatory agency review. These are very much related, but subtly different. Let's look at first the clinical trial results aspect of this risk. The results are really safety results and efficacy results from clinical trials. This is the big daddy risk. This is the biggest risk of all. This risk affects the approvability from the regulatory agency perspective, so it affects that risk, and it affects commercial success. Basically, the clinical trial results risk is the risk that there will be a positive or negative catalyst event report out, a positive or negative clinical trial report out. Those report outs many times move the stock price. So on AMP, we have this catalyst calendar on the ampbioresearch.com website. We have this catalyst calendar where we show upcoming catalysts for some of the companies, most of the companies that we follow. And you can see these events. Sometimes they're NDA filings. Those are actual filings for approval, or they're phase 1 or phase 3 clinical trial results. Can be any phase clinical trial results. And we also have this AMP volatility score. The AMP volatility score uses option prices to get a sense for how the market is factoring in any of the events that a company has coming up in a given time period, usually within 1 or 2 months, to try to assess how much the market is seeing as the possible move in the stock price based on these events, which many times are the clinical trial report outs or FDA report outs. So that's the big daddy of risks, the clinical trial results risk. But the second aspect of the regulatory approval risk is the actual regulatory agency review risk. Well, you say, wait a minute, there's risk even if clinical trial results are very clean and positive? There's still risk that the FDA, for example, won't approve a drug? Absolutely. Why is this? This is because of the CMC risk, the chemistry, manufacturing, and controls risk. And this is really hard for investors because we don't have insight into the specific interactions between the FDA and a company. Those are confidential, and usually we don't get much insight into that. So we don't know if the FDA is seeing issues with the manufacturing site. Are there standard operating procedure issues? Is the FDA not happy with the quality control at the manufacturing site? So this is a difficult risk for us to assess. We spent a good amount of research time at AMP trying to better quantify that risk, and maybe we'll talk about that at some point in the future. But to suffice to say that there is risk, the CMC risk, even when for FDA approval, even when there are really good clinical trial results all the way through the registrational phase 3 trial. So that's the second aspect of the regulatory approval risk. We have the clinical trial results risk and then the regulatory agency review risk. Second major risk is the commercial success risk. So even if the drug is approved it may not be commercially successful. Why is this? Well, maybe the results, the safety and or efficacy are not better than competitive products. Maybe the drug is too expensive for the benefit that it confers. We saw this with some of the cardiovascular drugs recently approved in the last few years for Amgen, for example. Or maybe there's an ineffective commercial team. We see this a lot. Keep in mind, these are small, mid-cap biopharma companies. If they get a drug approved and they're not acquired and they have to go off on their own and commercialize a drug, it's their first drug many times that they're commercializing, and they've got to go and compete against these well-entrenched, established, big pharma commercial teams, and it's very difficult for them many times. So we've got this commercial success risk even when we've got an approved drug, and so the market takes this into account as well. And then the third risk I want to talk about is the near-term dilution risk. Since these companies are losing lots of money, as I mentioned, they need to raise money periodically so they don't go bankrupt. And they do this by follow-on offerings. So hopefully they raised a lot of money in their initial public offering. Then they burn through that money as they're going through clinical development. They need to raise more money. They do this through these follow-on offerings. Now these can especially occur if there's a positive clinical trial result that really bumps the stock price up. Then many times the company will take advantage of this increased valuation and raise money, go out and sell more shares of stock. By doing this, they dilute current investors, so that'll bring the stock price down some. Now, the other way these companies can raise money is through loans, which doesn't dilute current investors. But usually loans happen, by and large, much later in the process, very near an approval or after a drug is approved. So usually the companies that we're dealing with are raising money through follow-on offerings, which gives us this potential dilution event. Now, on the AMP website, we have data about at least currently, we're still showing data around the burn rate of a company and how much cash they have on hand, and you can use that to get a better sense of when they'll need to raise cash. We'll do a separate educational session just on this topic. Now, how do these risks affect the stock price? So I mentioned, if you increase the risk, decrease the risk, the stock price is inversely proportionate there. And more specifically, so we've got a current valuation. Let's say we're doing a valuation model, use a comparative model, use a revenue multiple model, use a discounted cash flow model. Doesn't matter. The bottom line is you have some valuation, and that valuation then gets multiplied by the regulatory approval risk and the commercial success risk. So we may have a 90% risk early on in clinical development for regulatory approval and commercial success. And so I may take $1 billion base valuation based on the market potential of a drug, and then I might multiply it then by 0.1 for the regulatory approval risk because of 10% chance of success, and 0.1 for the commercial success risk because of a 10% chance of success. So I got $1 billion times 0.1 times 0.1. You can see that the valuation of this company is greatly affected by these risks. So clinical trial results can have an immediate and large effect on the stock price because they change these risks potentially dramatically in some cases. For example, if it's the first robust clinical trial, human clinical trial results for a new drug asset and a new indication, if positive, that can have a huge impact on lowering the regulatory approval risk. So you may go from a 90% or a 10% chance of success to a 30% chance of success overnight in a clinical trial result, in a positive clinical trial result. Now keep in mind, in those situations, first human clinical trial, robust human clinical trial, new indication, vast majority of those will fail. But sometimes they succeed and they drive the stock price, and that's when we're yelling, woohoo! And that's why we do this stuff for these wonderful, wonderful hits that happen sometimes. And then if that happens, many times there's a partial offset because the company will use that higher valuation to say, okay, let's raise some cash now, and that will adjust the price down. But in a good scenario, the price still is much more inflated from where it started before the clinical trial readout, even after dilution. So to summarize the three major risks, we have the regulatory approval risk. which has the clinical trial results aspect and the regulatory agency review aspect independently. Then we have the commercial success risk, and we have the near-term dilution risks. These are three specific, company-specific risks that affect the valuation of a particular company. I hope you've enjoyed this AMP educational quickie, and have a great day.